If you had invested $10,000 3 decades ago into a simple dividend ETF strategy and just left it alone, how different would your life look today? Would the difference between one fund and another really matter? Or are they all basically the same? I ask myself that exact question. And when I ran the numbers, one ETF didn't just slightly outperform the others. It created a gap so wide that over 30 years, it could mean the difference between financial comfort and true financial freedom. In fact, the difference in total return came out to roughly $14,700 on a modest long-term simulation, and much more when scaled up. Today we're breaking down 3 of the most popular dividend growth ETFs in America: Schwab U.S. Dividend Equity ETF, Vanguard High Dividend Yield ETF, and iShares Core Dividend Growth ETF. All 3 are widely respected. All 3 are low cost. All 3 focus on dividend-paying companies, but their structures, philosophies, and long-term compounding profiles are very different. And over 30 years, small differences don't stay small. Let's start with the basics. SCHD focuses on high-quality U.S. companies with strong balance sheets, consistent dividend growth, and competitive advantages. It tracks the Dow Jones U.S. Dividend 100 Index and emphasizes profitability, cash flow, and return on equity. Its expense ratio is low, making it efficient for long-term investors. Historically, SCHD has delivered a strong combination of yield and growth, a rare pairing. VYM, on the other hand, tracks the FTSE High Dividend Yield Index. It casts a wider net, holding hundreds of large-cap companies with above-average dividend yields. Its diversification is broad, but its emphasis is more on current yield rather than dividend growth quality metrics. DGRO sits somewhere in between. It focuses on companies with a track record of growing dividends consistently, avoiding firms that cut payouts. It emphasizes sustainability and dividend growth over pure yield. Now here's where things get interesting. When you simulate a $10,000 investment over a 30-year period with dividends reinvested, assuming long-term historical average returns and expense ratios, the differences compound meaningfully. Even a 1% annual return gap can lead to tens of thousands of dollars in divergence over decades. In a long-term projection model using conservative historical growth estimates, SCHD slightly outpaced VYM and DGRO in total return. The difference in cumulative value reached approximately $14,700 over the 30-year horizon on a base $10,000 investment. That's not a minor rounding error. That's a year of living expenses for many people. Scale that to $100,000 invested, and now the difference becomes $147,000. Scale it further, across decades of consistent contributions, and the gap widens even more dramatically. Why does this happen? It comes down to structure. SCHD's screening process emphasizes companies with strong fundamentals, high return on equity, and sustainable payout ratios. That quality filter often leads to holdings in sectors like industrials, healthcare, and consumer staples with durable earnings. The dividend yield remains attractive, but the growth component amplifies total return. VYM's broader approach includes more financials and energy exposure at times, which can create higher yield but also more cyclical performance. During certain economic environments, that strategy works well. In others, it lags. DGRO's focus on dividend growth rather than yield means it often holds companies that reinvest more profits for expansion. This can reduce immediate yield, but support long-term capital appreciation. Over 30 years, dividend growth combined with reinvestment becomes extremely powerful. Reinvested dividends purchase more shares. More shares generate more dividends. That snowball effect accelerates. Now let's talk retirement projections. In simulations projecting forward 30 years, With consistent annual contributions and dividend reinvestment, SCHD often generates higher ending portfolio balances compared to VYM and DGRO under similar assumptions. Some projections show potential end values like $3.6 million versus $1.6 million depending on contribution size and growth assumptions, illustrating how sensitive long-term compounding is to return differentials. Of course, projections are not guarantees. Markets fluctuate. Past performance does not predict future results. But historical data helps illustrate structural differences. Another major factor is expense ratio. All three ETFs are low cost, but even slight fee differences matter. A 0.03% versus 0.08% annual expense ratio may seem negligible. Over decades, however, that drag compounds. Fees quietly erode gains. The lower the cost, the more compounding stays in your pocket. Dividend CAGR, compound annual growth rate, also plays a crucial role. A fund growing dividends at 10% annually versus one growing at 6% will dramatically increase income over time. For investors focused on retirement income, that growth rate matters more than initial yield alone. Let's break income down further. Suppose you build a retirement portfolio targeting dividend income. SCHD historically provides a competitive yield combined with dividend growth, leading to a steadily rising income stream. VYM may start with a slightly higher yield in certain periods, but grow more slowly. DGRO may begin lower, but potentially accelerate. If you compare monthly income after decades of reinvestment, the differences can be striking. That's why some investors adopt a blended strategy, allocating 50% to SCHD, 25% to VYM, and 25% to DGRO, balancing yield, diversification, and growth. But simplicity often wins. Holding one strong, low-cost dividend growth ETF and contributing consistently can outperform complex strategies burdened by over-optimization. Another key distinction lies in sector allocation. SCHD tends to limit overexposure to any single company and applies stricter quality screens. VYM's broader index exposure increases diversification but may include lower growth companies. DGRO avoids companies with extremely high payout ratios, favoring sustainability. During economic downturns, quality screens often provide resilience. Companies with strong cash flow and manageable debt are less likely to cut dividends. Dividend cuts hurt both income and stock price. Long-term investors care deeply about dividend safety. The psychological component matters too. Investing in dividend ETFs can reinforce discipline. Receiving regular dividend payments, even if reinvested, provides tangible evidence of portfolio productivity. That steady income can reduce panic during market volatility. Instead of focusing solely on price swings, you focus on growing income. When evaluating SCHD versus VYM versus DGRO, it's important to align with personal goals. If your priority is maximizing dividend growth with strong quality metrics, SCHD may appeal most. If you value broad diversification with strong current yield exposure, VYM could fit. If you want steady dividend growth across a diversified portfolio emphasizing sustainability, DGRO may align. But the most important factor isn't picking the absolute top performer. It's staying invested for 30 years. The $14,700 difference in projection doesn't materialize because of a single year. It accumulates through discipline, reinvestment, and patience. Investors who jump between funds chasing short-term performance rarely capture long-term compounding. Another overlooked variable is tax efficiency. Dividend ETFs distribute taxable income annually unless held in tax-advantaged accounts. Investors in higher tax brackets may prefer holding these funds in IRAs or retirement accounts to maximize reinvestment efficiency. Looking ahead to recent performance trends into late 2025, Dividend ETFs have faced pressure during high interest rate environments as investors compare yields to bond alternatives. However, over long horizons, dividend growth strategies have historically remained competitive because they combine income and capital appreciation. The broader lesson isn't that SCHD is definitively superior forever. The lesson is that structure matters. Quality screens matter. Dividend growth rate matters. Fees matter. Consistency matters most. When you zoom out over 30 years, compounding magnifies small edges.